Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
It is the first full week of January 2026, and wow, the global financial environment is. It's showing this stunning, almost paradoxical blend of record-setting optimism and at the same time rapidly escalating geopolitical risk.
That tension is exactly why we're here. For this deep dive, our mission is to synthesize these huge market movements and the global flashpoints that are really defining the start of the year. We're pulling key insights from analysis across Business Insider, The Wall Street Journal, and of course, CNBC.
And we are tracking a fascinating divergence. On one hand, you've got the Dow just crossing 49,000. All-time highs driven by tech.
Unbelievable.
But on the other, the market is simultaneously building in global conflict as a permanent systemic risk factor. It's a trend experts are now calling the new era of geopolitical risk.
So we're going to explore how that permanent risk is driving this bizarre split in commodity markets, the unexpected fallout from the U.S. action in Venezuela, and frankly, some slightly unsettling revelations coming out of prediction markets.
Let's start there with how geopolitics is, actually rewiring the market.
Right. So where do we begin?
We can start with a major thesis from Oxford Economics, which was detailed in a big report highlighted by Business Insider. Their research shows that geopolitical conflict isn't treated as a temporary shock anymore. It's become a fundamental, permanent pricing mechanism.
That's a huge conceptual shift.
Yeah.
So you're saying analysts aren't just reacting to the crisis of the moment, they're building in a perpetual standing risk premium. Why now? What's changed since, say, the Gulf Wars?
The big change really accelerated around 2022. It's driven by three big factors. One is ongoing supply chain fragility.
We all remember that.
Exactly. The second is trade fragmentation, the fracturing of global trade blocs. And the third is resource nationalism. Oxford Economics argues that because these are structural problems, the risk is now just. It's baked into investment decisions. It's not something that gets priced out when a headline fades.
And the most potent immediate example of this playing out just this week was the U.S. military operation in Venezuela, the capture of Nicolas Maduro.
Right.
Now, given Venezuela has the world's largest oil reserves, you would expect absolute panic in the markets. What was the actual reaction?
The initial reaction, and this is according to analysis in the Wall Street Journal, was shockingly quiet. It was a collective shrug.
A shrug.
A shrug. Stocks mostly just kept climbing on Monday. They were focused on positive fundamentals, the AI rally, everything else.
A military op in a major oil state is just background noise.
Yeah.
That feels like a stunning level of complacency.
It does, but experts were quick to clarify why. Edward Jones strategist Angelo Korkafas pointed out that the news, quote, carries no immediate implications for oil supply. And that's the factor markets truly care about.
Oh. So because Venezuela's production is already so decimated, the raid didn't disrupt anything that was currently flowing.
Exactly. But it did set a precedent for forceful international strikes, and that immediately redirected attention to other potential flashpoints.
Which confirms that systemic risk factor you mentioned.
Absolutely. The focus immediately pivoted toward the Arctic. Just hours after the Venezuela news, the White House press secretary, Caroline Leavitt, confirmed to CNBC that the administration is considering a range of options to acquire Greenland.
And that includes?
It includes, and this is a direct quote, utilizing the U.S. military.
Which, of course, immediately creates a crisis with Denmark, with Europe. Their reaction was fast and expensive.
It was. Denmark announced it would spend a staggering 88 billion Danish kroner. That's about 13.8 billion US dollars on rearming Greenland. And they cited the serious security situation, as reported by CNBC. That's a massive reactive defense spend triggered by a geopolitical move half a world away.
And that kinetic energy, it seems to have translated directly into perceived risk elsewhere.
Yeah.
Where are traders betting on this going next?
The prediction markets are a fascinating barometer here. CNBC analysis highlighted that on Kalshi, the odds for the U.S. to take back the Panama Canal by early 2029, they jumped.
How much?
They jumped above 35% right after the Venezuela raid. The market is clearly thinking that once one of these muscular actions happens, others are more likely to follow.
And that brings us perfectly to our next segment. The bizarre divergence in commodities, because if geopolitical risk is permanent, you'd expect a flight to safety.
And we are seeing that.
But we're also seeing these fragmented signals in industrial demand. Let's start with the safe havens.
They have absolutely delivered. Business Insider and the Wall Street Journal have been detailing the exceptional performance of precious metals since 2022. Gold, driven by this structural fear of more conflict, has soared to about $4,510 an ounce.
And silver is running right alongside it, which is unusual. For silver to sustain prices this high with gold usually means the underlying fear is really, really pervasive.
Correct. Silver futures climbed above $80 a troy ounce for the first time this week. They hit 81.30 on Tuesday. This is a sustained rally. It confirms investors are using these metals to permanently hedge against risk.
Okay, now for the divergence. Industrial metals are also rallying hard. That usually signals robust global growth, which that kind of contradicts the whole fragmentation story.
Yeah.
So why is copper breaking $13,000 a ton?
Right, and this is where you see the fragmentation thesis at work, not global confidence. Copper surge is primarily being attributed to worries about potential tariffs from the Trump administration.
Ah, so it's not a huge new wave of global construction demanding copper. It's firms trying to get ahead of tariffs,
Precisely. It's U.S. firms doing massive stockpiling. They're trying to build inventory before any import taxes hit.
which creates artificial shortages everywhere else.
And that warps the benchmark price. It's
Yeah.
a perfect sign of fragmentation, not smooth industrial demand.
Okay, let's tackle oil then, the ultimate outlier, especially after the Venezuela operation. Crude prices actually fell. WTI dropped 1.5%. How does a military action in a country with 300 billion barrels of oil cause prices to fall?
This is the paradox, right? It's political messaging colliding with market reality. President Trump promised the U.S. would eventually receive up to 50 million barrels of Venezuelan oil.
A promise.
A promise. And that announcement, regardless of the timeline, immediately created fears of future oversupply. It pushed crude futures down.
But the experts are all saying the production in Venezuela is in ruins, right?
It is completely decimated. The Wall Street Journal outlines this clearly. Venezuela has those massive reserves, yes, but current production is less than 1 million barrels a day.
Down from what, 3.5 million?
Down from 3.5 million in 1997. The reality is, any meaningful supply increase will be gradual and could take years. But the market reacted to the promise of supply, not the current reality.
And there's a technical signal that confirms traders aren't panicking about scarcity. For our listeners, can you quickly break down what contango versus backwardation tells us?
Absolutely. We're looking at the price of oil today, the spot price versus the price for delivery in the future. Right now, the market is in contango.
Meaning future prices are higher than spot prices.
Exactly. It signals ample supply. Traders are basically willing to pay a premium for storage to get the oil later. Contango says, I have enough oil now. I'll pay you a little extra to hold it for me.
And backwardation is the opposite.
Backwardation is the panic signal. That's when the spot price is way higher than the future price. It's the world screaming, I need oil now. The fact we are firmly in contango, even after the Venezuela raid, tells you the market believes supply will hold.
That structural comfort brings us to, well, a really unsettling subject, the prediction markets themselves. This Venezuela raid story has raised some serious ethical questions.
It really has. The specific anecdote, first highlighted in an investigative piece we saw, is, well, it's impossible to ignore. A user on Polymarket turned a $33,000 bet into over $436,000.
And what was the bet?
They wagered that Maduro would be ousted before the end of the month. The winning wager was placed just hours before the U.S. raid began.
A gain of over 10 times the initial investment, placed hours before classified military action. I mean, that's not luck. That sounds a lot like insider trading.
It does. But these markets, like Polymarket and Kalshi, seem to operate in this strange regulatory vacuum. They're handling billions in bets on political outcomes, but legally. They're often not classified as gambling.
So the same rules don't apply.
Often, no. They frequently operate without the specific insider trading prohibitions that govern the stock market.
So beyond the obvious, profiting from classified information, what are the broader concerns the sources raised?
There are two big ones. First is the influence of money itself. The potential for wealthy donors to inflate numbers on these markets to influence public perception or create a narrative of inevitability around an outcome.
And the second?
The second is more philosophical. It's this unsettling feeling of gamifying our existence, making these profound, sometimes violent political events a subject of betting. It turns policy into a high-stakes sport.
And as you mentioned, these markets are already signaling where the next flashpoints might be. Greenland, the Middle East, they're giving a real-time risk assessment that traditional analysis can take months to produce.
They are reflecting and maybe even amplifying where this new era of geopolitical risk will strike next.
Let's shift gears completely. From kinetic conflict to the AI arms race that drove the Dow to 49,000. Let's talk about the news out of CES 2026.
Yes, the annual CES conference just showcased this absolute intensification of the chip wars. NVIDIA unveiled its next-generation Vera Rubin AI superchip platform. This thing is ideal for handling complex agentic AI, advanced robotics.
And then immediately set the stage for a counterpunch.
And AMD delivered. CEO Lisa Su gave a first look at their rival Helios system and the new MI500 series data center GPUs. They're aiming for something like 1,000 times increase in AI performance over older models.
1,000 times.
It was a clear declaration of war on NVIDIA's dominance.
But despite these phenomenal promises, the market was a bit skeptical. NVIDIA's shares actually slid a little.
Right. It suggests investors are getting worried that this massive competition and the exponential spending that comes with it just isn't sustainable forever. But the real market action wasn't just in the chip makers, it was in the supply chain underneath them.
You mean the data storage stocks?
Exactly. We saw these massive disproportionate gains, SanDisk up 28%, Western Digital up 17%, Seagate up 14%.
And that's a pure play on the demands of training these new AI models.
It absolutely is. These new systems require astronomical amounts of data to train and run, so that translates directly into a furious, non-negotiable demand for enterprise solid-state drives. The sheer volume of data is creating enormous revenue spikes for the companies that build the physical storage.
And then there was the cooling conundrum, an unexpected secondary market impact. Why were traditional HVAC stocks suddenly punished?
This is a perfect example of how niche AI tech can disrupt established sectors overnight. Stocks like Johnson Controls and Carrier Global saw an unexpected downturn. And it's because of investor concerns that NVIDIA's new Vera Rubin systems could leverage advanced liquid cooling.
So if liquid cooling takes off, the demand for those massive standard air conditioning units that these companies supply to data centers, it just drops off a cliff.
Exactly. Investors are betting the extreme heat from these new high-density AI systems will make air cooling obsolete. And that fear, even if it's speculative, is enough to punish these huge, long-established infrastructure giants.
So let's move to the broader financial currents and tie that record-setting Dow back to the underlying structure of the economy. We saw the Dow close above 49,000. It's the best three-day start to a year since 2003. But this rally really highlights the persistence of the K-shaped economy.
The K-shaped recovery is a vital part of this story. It's that divergence where the wealthiest asset owners, the ones holding the stocks, see their wealth gain dramatically. That's the upward stroke of the K.
While salaried workers struggle, the downward stroke.
Exactly. And the art market, of all places, provides the most vivid illustration of this.
How so?
According to analysis in the art newspaper, we're seeing high-end auction sales just soaring. It's a huge rebound for big-name, big-ticket art like that Gustav Klimt portrait that sold for $236 million. But this segment is deeply reliant on the wealthiest 0.001% of collectors.
And you mentioned some stunning figures about how concentrated that value is.
It's extremely concentrated. Art that sells for over $1 million accounts for 77% of the total sales value at major auction houses. But here's the kicker.
Okay.
That 77% of value is driven by only 7% of the volume of lots sold. The biggest value is supported by the fewest buyers.
So the market looks incredibly healthy if you only track the headline sales, but 93% of the actual items being sold are struggling to find value.
Precisely. Meanwhile, the speculative and young contemporary artists, smaller galleries, they're seeing a painful contraction, widespread closures. The art market is performing brilliantly as a wealth storage tool for the hyper-rich, but it's struggling everywhere else.
Okay, before we wrap up, two quick corporate highlights with big implications.
First, a huge legal battle is brewing. Bayer announced it is suing the COVID-19 vaccine makers, Pfizer, BioNTech, and Moderna.
On what grounds?
Bayer is alleging they used its proprietary mRNA technology and committed patent infringement.
Wow. That lawsuit, if it succeeds, could reshape the future royalty payments for the entire mRNA space. Investors will be tracking that very closely.
Absolutely. And second, a big structural shift in the Middle East. Saudi Arabia announced plans to open its financial markets to all foreign investors from February 1st. They're getting rid of the restrictive qualified foreign investor rule.
A clear move to attract more foreign capital and boost liquidity.
For sure. It's a huge liberalization signal. Now, analysts at JP Morgan think the immediate impact will be gradual since most big institutions already had access. But it signals a broader commitment to integrating their markets globally.
Just another piece of that global trade fragmentation and realignment puzzle.
Exactly.
So what does this all mean when we put the record Dow, the AI surge, and this permanent geopolitical risk premium all together for you, the listener?
We are operating in an environment of maximal cognitive dissonance. You have two opposing forces. Equities are roaring, driven by AI momentum, showing incredible resilience. The VIX is low, the Venezuela rate was shrugged off.
Right.
Yet this optimism is set against a permanent, escalating geopolitical risk. And that risk is clearly favoring safe havens like gold and warping commodity prices like what we see with copper and oil.
So the market is fundamentally betting that no matter how messy the world gets, Greenland, Panama, tariffs, whatever, the AI-driven earnings momentum will just continue, driving wealth creation at the very top.
It's a high-stakes wager, a wager on technological advancement overriding systemic global risk. But that raises an important question for you to think about.
Okay, let's hear it.
Considering the market's current comfort level with all this turbulence, I mean, the low VIX, the shrug off of Venezuela, what global flashpoint, maybe one that's being bet on right now in those prediction markets, would actually be severe enough to shift the oil curve into backwardation and definitively stop this bull run?
A fascinating and, an unsettling question to end on. Thank you for joining us for this deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.